So my role today is just to help to educate and provide maybe some resources. I hope that each and every one of you gets something out of it. It's not a it's not a concrete science. It's constantly changing some of the rules and things, and certainly, as you know, some of your investments change over time. So we're going to talk about tonight what your priorities are. You're going to notice a theme from the last few sessions, as we're always talking about plans, and today we're talking about priorities, which would be part of your plan. Benefit from tax deferred investments, and we're going to talk about what those are and how they can help you. Investment types, risk management, and how to protect your investments. So the last section of this is going to primarily deal with the different kinds of insurances and how you need to use them to protect your things. Okay. And again, I know that everybody is different. So feel free to type your questions in or call me in the morning, whatever you like. So if you haven't already, if you haven't been listening to my previous presentations about budgeting and plans, then you're going to ask yourself tonight, where are you now? Where do you want to be? And how do you want to get there? And each one of those has a short, medium, and long-term goal attached to it. So if you want to
building wealth,
somebody's got their mic on.
Horoscope for rich people.
Not sure how that works, Sam, but we got a mic on somewhere.
If those of you who are watching, if you don't mind to make sure you mute your mic at the bottom left-hand side of the screen, there should be a mute button that will allow Ed to present without getting distracted.
Okay, we'll carry on. I'm not going to get distracted. It just might be pretty difficult for people to hear over it. That's all. So you establish those priorities, and they can be something as simple as a new dishwasher or something as grandiose as a cabin on the lake, and everything in between. So everybody's different. And then you need to know how you make your money, because the way you make your money determines the way in which it is taxed. So there's interest income, there's dividend income, there's capital gains income, and of course there's earned income, which is the stuff you earn when you're actually working. So we're going to talk about the different kinds of investments and tax deferrals. So currently in this country, we have 3 registered accumulation plans. We have a Rrsp, which we just finished with last week, which was the end of February, March 1st, actually. We have the Rsp, which is for Registered Education Savings Plan. Impressive. And the tax-free savings account, which is in some cases better than an Rrsp for people, but we're going to discuss those options. So with an Rrsp, investments grow tax deferred, contributions are tax deductible, and the investments grow tax-free. Or sorry, they don't grow tax-free. They compound tax-free, but when you take them out, you are going to pay tax on them, okay? The Registered Education Savings Plan, investments grow tax deferred, again, just like the Rsp, tax deferred. When you withdraw them, you will be taxed on them. There is no deduction for an Rsp, and other than the time limit that is established for when the latest you can make contributions for a specified beneficiary, there really is no deadline. Tax-free savings accounts, you don't get a tax deferral for them. And the growth grows tax-free. So you could put $10,000 in a tax-free savings account, hit a home run, turn it into $100,000. This is a huge exaggeration, but turn it into $100,000, and the $100,000 is all yours. You will never pay tax on it. Non-registered investments. So if you have savings accounts which are not any one of those 3, RSPs, TFSAs, or RESPs, then they're non-registered, or what we call open accounts, and they are taxed on an annual basis. So I talked a little bit about this already certainly in previous sessions. So what is an RSP? It is a registered retirement savings plan. Savings plans that are registered with Canada Revenue, contributions are 100% tax deductible to your marginal tax rate. So if you're in a marginal tax rate of 32%, for example, and you invest $1,000 in an RSP, it doesn't mean you get a whole $1,000 back. It means you get to the extent your marginal tax rate is. So you would get 32% or $320. So the return you get is based on your marginal tax rate. Gains are tax deferred until funds are withdrawn, and each dollar withdrawn is included as income and taxed. If you've ever contributed to an RSP and had to withdraw it early when you're still earning income, you're going to have cursed them, because the benefit that you would have got when you put in, you would have more than likely paid that and more when you withdrew it. Tax-free savings account. So these are a relatively new, I think RSPs were brought in the late 50s, the early 60s, 1950s or 60s. Tfsa has only been around since 2009, and it's eligible. Anyone that's 18 years of age or older can contribute in Canada. While invested in the plan, their money grows tax-free, and it shows the list of the maximum contributions that could have been made over time. So if you've never contributed to a tax-free savings account, which lots of folks have not, these amounts are cumulative, so they carry forward. You don't lose them. Now, in the bottom right-hand corner of your screen, it shows there's a cumulative as of 2020 of $69,500. The government gave us a further $6,000 allowance in January of this year. So now, if you've never contributed, your total amount that you could contribute today is $75,500. So it's starting to represent a pretty significant amount of money. Just to go back to that, if you've got children, adult children who have never contributed, just remember that it started in 2009.
What do you do with the underwear?
What?
I don't know if anybody else heard that or not, but
I'm going to just remind everybody that if you want to mute your mic at the bottom of your screen, then it'll be easier for you to hear, and as well as anyone else listening in. Thank you.
okay.
Skirt.
So comparing RSPs and tax-free savings accounts, who knew we were going to have a little entertainment here tonight? Primary purpose of both the RSPs and TFSAs is for retirement, but the specific purpose of an RSP is retirement savings. It says there's no age eligibility. There actually is. You have to be eligible to have earned income before you can make contributions. So you had to have been working. You can't do an RSP at age 14 because you legally cannot work yet. And then RSPs are completed at age 71. So there are circumstances where you can contribute to spousal RSPs, and we'll talk about those. Maximum contribution limit on an RRSP. This is
I have questions.
Somebody has a question.
If Ed, are you?
I have a number as well, but I suspect
I don't think they're talking to us, Sam.
Okay. Just to let everyone know, if you just tuned in, if you do have questions for Ed, feel free to type them in the chat box at the bottom of your screen. You just hit that icon and type away, and we will be answering questions at the end of the presentation.
Thanks, Sam.
That is a place to keep a Magikarp.
Apparently they're not listening. Anyway, we're going to carry on. We're not going to allow this to distract us anymore. So that maximum is if you're making the maximum amount of income. Otherwise, your notice of assessment from Canada Revenue Agency, which you receive in May, June of every year, that thanks you very much for filing your taxes and paying them. It will tell you what you have for carry forward room, and it will also tell you what you're eligible to contribute for the next 12 months. Contributions are tax deductible, unused carry forward room. So if you've never contributed to an RSP, it will carry forward for you as well. It grows tax deferred. Withdrawals, when you take money out of it, are taxable, and we're going to talk about that when we talk about Rsps. Withdrawal amounts are not added to, so if you take it out, you've lost that room. You never get it added back into it again. And you have to turn an RSP into an RRIF, or a registered retirement income fund, by the end of the year in which you turn age 71. And you can also contribute to a spousal RSP, and we'll talk about that. We're going to pick up the pace because we're starting to fall behind time here. So a TFSA, there is no good reason not to have a tax-free savings account, in my opinion, with the possible exception if you're a dual citizen. If you are a U.S. citizen and you have to file the U.S. tax return, then likely your accountant has told you you should not have a tax-free savings account. And I think that is because, with my vague understanding, is that it's not taxed the same way as we are in Canada, which is tax-free. It's taxed full on from the US government when you file your tax return. So you'll want to clarify that with someone that is a little more knowledgeable on US tax than I am. No upper age limit, so you can contribute to this forever. You can be 95 years old and still contributing to a tax-free savings account. We're going to talk about some of the drawbacks with the RIF here shortly. Registered education savings plans, and we're going to burn through this one really quickly because it's either next week or the week after we have a session concerning registered education savings plans. Contributions are allowed until the plan's 31st anniversary. So if you start this up when the baby's first born, at the end of the 31st year, it will have to be collapsed. Maximum contribution, $50,000. Contributions are not tax deductible. The big thing with this is you get a 20% grant from the federal government for every dollar that you put in an eligible year. So to a maximum of $2,500 per child per year. So if you put in $2,500 per child per year, the government will give you $500. The rules are coming up, so I'm not going to circumvent that. So investment types. Actually, I'm going to go back to that just for a second. If the money isn't used, so there are contractual plans and there's non-contractual plans. We're going to touch on this right now because this is important. There are a number of RESPs out there, registered education savings plans. Some of them require contracts, so you have to commit to paying X number of dollars a month for X number of years. Non-contractual plans, you can purchase, put money into them willy-nilly, if you will. So you could put in $100 or $500 or $2,500, or you can do it on a systematic basis as well. But if you decide you're not going to put any money in that year, there is no penalty to do that. Whereas a contractual plan, sometimes there is. So if you have one of those plans, you should talk to your provider about how they operate. And if you can't reach them or you're afraid to talk to them, give myself a call or someone else that's in the industry a call, and we'll do our best to help you decipher it. So investment types, there's stocks, there's bonds, which I'm not licensed to discuss either one of those. So I'm just telling you they're there. There's mutual funds, there's segregated funds, which are a mutual fund with an insurance wrapper, if you will. There's guaranteed investment certificates, and I would think everyone's familiar with GICs. And then there's accumulation annuities, which are an insurance GIC. There's very different aspects to each one of those. So again, very quickly, Stocks, you share in the company profits. They're generally on a higher risk return profile, because if you're buying a individual stock of, for example, WestJet, so as WestJet stocks go, so does your money. There's nothing to offset it. Potential for higher growth over time, and it's suitable for longer term goals. And you need to understand your risk reward ratio and where you're at in that regard. You can trade these things individually through your direct. I think our RBC's account is an RBC Direct, I believe is what it's called. Every bank has their own individual discount brokerage. That was the word I was looking for. Bonds, so they're used, they're lending instruments to governments or businesses. So bonds pay interest. So if you buy a corporate bond, you're actually giving your money to that corporation, and they agree in turn to buy you or pay you interest on that. And then at the end of the period of time to redeem that bond. So interest rates on the bonds depends on the credit worthiness of the borrower. So if you've got someone that's maybe a little sketchy, maybe they're offering to pay you 7 or 8 or 9 or 10%. Or there could be other reasons, but usually they're not offering those kind of high rates if they could get money at a lending institution. There's an inverse relationship between bond price and interest rate. So the higher the interest rate, the lower the bond price, and vice versa. These are suitable for short and long-term goals as well. Again, available through a stockbroker. Mutual funds. So mutual funds are a large pool of money belonging to many people that experts invest in stocks, bonds, or other securities. So you take your money, your $10,000 or whatever amount, you come to see someone like me who puts you in, after discussion and determining your profile, puts you into a certain mutual fund. In a mutual fund, there could be anywhere from 30 to 60, maybe more different stocks and bonds. So you're buying a portion of each one of those. So as a result, you're a little less subject to market volatility. You're still subject to it, but there's a good chance that in those 30 to 60 different stocks, that not everybody's going to be losing money at the same time. And of course, by doing that, you hope to achieve greater investment returns than, putting it under your mattress, and the returns are then passed back to the investors. There is a fee associated with mutual funds, and that's what will be discussed with you when you go in to talk about them. So different kinds of mutual funds. So you've got GI, money market money, bond, balanced, which by definition is 60% equities and 40% bonds. And then you have an asset allocation tool, which would be a little bit similar to the balanced objective, but quite often they can go a little higher equities. And then you have pure plays. So if you've heard that, so there's pure Canadian equities, there's pure global or international equities, which would include US equities, and then specialty funds. Right off the top of my head, I can't think of an example, but I'll think of it as we're going along. So the higher the risk, the higher the potential return. But there is volatility, and you need to understand your risks. And if you're dealing with a reputable firm, they'll help you determine what those risks are and make sure that you're well suited to what you're looking for. A segregated fund contract is very, very much like a mutual fund, except that it offers some guarantees, where a mutual fund does not have any guarantees as to future returns, and you can lose some or all of the principal you've invested. They will offer similar mutual funds, but there will be an insurance base to it. So it will guarantee that if you hold the product for a certain period of time, they'll pay you back a percentage of your money if the market craters. There's also death benefit guarantees. What I just spoke about was they'll pay you money back if you hold it for a certain period of time, is the maturity benefit. Okay. Suitable for a wide range of time frames. There are a number of different segregated funds out there that will also convert to annuity streams or income streams for you. So if you're not happy with low interest rate environment, a segregated fund contract may work for you. GICs, so it's a Canadian investment that operates guaranteed or offers guaranteed rates of return over a period of time. Generally a very low risk to reward profile. Certainly right now with interest rates as low as they are, value does not fluctuate with the markets. They're suitable for short to mid-term goals as a rule. Some folks find right now that they're into long-term goals. They've got their retirement dollars there because they just can't stand the risk associated with the market. And you can purchase these products in redeemable and non-redeemable. That's one thing that I find a lot of folks don't necessarily understand. So you need to make sure whether your GICs, when you're putting them in, particularly in a tax-free savings account, whether they're redeemable or non-redeemable. If you're putting them in there to get the money out when you need it and they're non-redeemable, they're not doing what you want. Accumulation annuities look like a GIC, but they have an insurance benefit. And I said I would talk about this a little bit more. They have the same guarantee for your principal and rate of return as a GIC do. They, though, have an ability to designate a beneficiary on a non-registered or an open account. So if you have a savings account that is not a tax-free savings account, it's not an Rrsp, and you want your children to receive it, for example, upon your passing, in an accumulation annuity, you can assign beneficiaries. What's the advantage of that, you ask? Well, you can avoid probate and any potential legal challenges surrounding your will or your estate. So if you've got a couple $100,000, for example, on deposit, and you want to make sure that your 3 kids receive that, irregardless of what goes on, then you name your 3 kids as beneficiaries upon your demise. There's a claim form signed and the money flows directly to them. So it provides the beneficiary designation. It also stays out of the estate, so it's private. Because your will, we're going to talk about that in another week or so as well. Your will is a public document once it's probated. So if you don't want anybody to know who's getting your money and it's being distributed by a will, well, good luck. They can find out after your demise, of course, but through a accumulation annuity, that would not occur. Potential creditor protection. That's something that a lot of folks, most folks do not know. If that's something that's of interest to you, then you need to talk to a life insurance advisor, of which I'm one, but there are many, and you can ask them about accumulation annuities. Protected by insurance legislation. So GICs, you've often heard the banks talk about guarantees with their GICs. That's guaranteed by an organization called CDIC, Canadian Deposit Insurance Corporation. Accumulation annuities, which is the insurance GIC, are protected by a similar organization. I believe it's Rsps in the insurance industry. Managing risk. Just got to check our time, make sure we're okay. So investments will fluctuate over time. So depending on the types of market you're in, the types of rates of return or interest rates that you want to achieve, the inflation rate, and of course the business risk all affect how much money you're going to make over what period of timeline. So you're all going to recognize this. This is, that yellow line could be indicative of a stock market. Okay. All it's doing is demonstrating that it could be a ride. This is kind of interesting, and it certainly bears out. I've been in this industry for, I think, going on 27 years now. And so this is the cycle of market emotions. So lots of folks, when the markets are soaring like they are right now, and there's lots of sectors that are doing really good, that people get all excited and they'll jump right in, with their whole savings, particularly if they've gone through a period where things have been a little slow, like we've experienced in this whole world for the last almost 12 months now, people are looking for excitement. So they'll jump into the market will continue to grow, you know, thrill, euphoria, and then it starts to peak and down the other side, and they'll get a little anxious, and then there'll be a little fear and denial and desperation and panic, and then ultimately somewhere down here in the bottom, they just say, I can't lose anymore, and they'll jump ship, and then it'll start up the other side. And I've seen this happen far too many times in my career. That's why we work diligently to try and ensure that people understand the risks and rewards associated with their decisions, and to ensure that your risk profile is right. So you understand the risk tolerance, diversification, and dollar cost averaging. We're going to talk about that now just a little bit. So risk tolerance is a degree of variability in investment returns that you are willing to withstand. So if you're just beginning your career, and these are generalities, right? You can increase your portfolio's long-term investment risk and set yourself up for higher potential returns. That doesn't work for everybody. Generally, they say that if you're younger, you should be able to take more risks, but not everyone is built that way. But it's your time horizon. You know, if you're starting your career at 25, you know, presumably you've got a long time to live and a long time to save. But if you're just not comfortable with the risk, you don't let yourself be talked into it. Midway through your career, you make the most of the time you have to grow your investments. So you'll generally see folks kick up their risk levels a little bit here, but not always. Sometimes it's slow and steady wins the race. And then getting close to retirement, align your portfolio with your retirement income goals. And sometimes that equates to reducing risk, but sometimes not. So again, everyone is individual. Everyone needs to be dealt with on an individual basis. One size does not fit all. Diversification. So this is a strategy you use to share the risk, right? You don't want all your eggs in one basket. I'm sure you've heard those terms before. So the most common types of asset or investment classes is cash or equivalents, fixed income securities such as bonds or bond funds, and then equities such as stocks or equity funds. So what on the right-hand side it shows you is you can buy managed solutions like this. So from an investment dealer, you can go in and talk to them, and if your risk profile says your risk profile says that you're a conservative investor, then you might consider something like this. Understanding there is risk. Even though it's conservative, there is still a potential for it to go down. So you need to review those things called fund fact sheets with your advisor and make sure you understand what your risks are. Dollar cost averaging, don't hear much about that anymore these days, but what this is instead of throwing, you know, $1,000 in at the end of the year, that you consider investing a certain amount monthly. So what this slide shows is dollar cost averaging. You know, theoretically, the markets are going up and down on a monthly basis. If you throw $100 in every month, you know, one month you'll be buying at a $10 unit price, the next month at a $5 unit price, you know, the third month maybe a $7.50. And so the number of units you've bought are much greater. And so you end up at the end with 443 units, as opposed to if you'd have bought all 300 at $10, you'd have got 30. So the potential there is you've got, if you equate it to shares, you've got 13 more shares than you would have had the other way. Okay. So the average price paid per unit on this particular slide is $6.93, not the high of the 10. And you received more units. So I have no idea as to the demographics of the people that are listening to this, but when is the best time to start? The best time is always to start as soon as you can, even if it's only a little bit. We talk about paying yourself first. And again, we go back to talking about budget and making sure that, you know, you've got some to do that with. But if at age 25 to age 65, you've contributed $48,000 and you started at age 25, that turns into $196,000. And you can see how those numbers vary as you go along. And that's the benefit of compounding and time, right? So I believe this is at a, Sam, I got my picture in our way again. Yeah, a 6% annual rate of return with $100 per month contribution. So it may be doable. It may not. Not everybody's the same again, but you know, if you can swing $100 a month starting at age 25 and stay on track and do it month in and month out at a 6% rate of return, which should be pretty achievable. It certainly has been in the last number of years. That's the kind of money you can expect. So one of the ways that you can protect your investments, other than taking it away from the bank and putting it in a coffee can and burying it in your garden, is to purchase insurance products. And what they will do is they will protect your investments against you needing to withdraw the money early because of a personal or financial crisis. Okay, so some of the insurances that may help you to deal with that situation is disability or income replacement insurance, critical illness insurance, life insurance, or other controllable events. So there is a definite link between health and finances. So this survey was taken way back in 14. Geez, it's old already. But back then, 7 in 10 Canadians did not expect to retire as planned. I'm going to suggest to you that that number is probably higher. Not just because it's health related today, but because people are having to work a little longer. And so that's where the income replacement tool starts to come in, is because you may be a little longer in the tooth now and running the risk of possibly having an injury occur to you at work. We have talked in other previous sessions about the top stressors, and the top 3 stressors for Canadians, one of them is finance related stress. So again, if you have a plan, hopefully we can help to alleviate some of that. And if part of your plan is to insure events in the event of something happening to you or your spouse or one of your loved ones, then it relieves some of that pressure. Hopefully you never have to use it, but it's like any insurance, it's there to insure you against that potential loss. So again, an old slide, but half of Canadians have experienced at least one of these serious illnesses before retirement. So a terminal illness, a serious health event, an accident, chronic or degenerative condition, or a mental health issue. So what's available to help you out? Well, one of the things is personal health insurance. And that's a product that's available from many different outlets. In this province, Alberta Blue Cross is one that you quite often will hear about, but certainly Manulife, Sun Life, Great West Life. I mean, I'm not going to start listing them all, but many have them. And these are plans that help to offset drug costs. They can help to offset emergency travel, medical, supplemental health care, dental and vision, private hospital rooms, and paramedical practitioners. So massage therapists, chiropractors, the like. If you don't have a product like this, it's something you may want to consider. Depending on your age and your state of health, you may or may not be able to get it, because with health insurance plans, normally they take a look at your existing health. And if you have pre-existing conditions, such as taking some prescription drugs, you may be eligible and be able to purchase the plan, but you may not be able to have that particular product covered because it's a pre-existing. Okay. What happens if I get hurt? Well, then what happens is you may run the chance of not being able to pay your mortgage, not being able to cover your living expenses, your utilities, your child care, and so on and so forth. So the product that is available to help you with that is, and look at that, I just watched a webinar today where this happened to the guy. So we're going to talk about disability insurance. I know it. I know it's in here somewhere. But the product that we use to protect your mortgage if you get hurt or any of these other things is what we call disability insurance. What we're talking about here is term life insurance. So that's a product if you're got a young family, particularly, you don't want to spend a lot of money on life insurance to ensure that if something happens to mom or dad or to one of the children, that you've got some money to cover those final expenses and to help you carry on with life for a period of time. Then term insurance quite often will give you the biggest bang for your buck. I want to mention at this point that term insurance also is the product that we will use almost exclusively to cover off mortgages. So if you have a mortgage or a long-term debt and you have it covered with mortgage insurance through your credit or institution, you're going to want to shop it. Just shop, just check prices. If you've reached a certain age, you may be paying more than you need to pay, and we've been talking about saving money and budgeting, and it's all about making sure you've got your costs covered. So if you have protection insurance through your lending institution, just ask them or look on your statement, find out what you're paying, and then call a life insurance advisor and ask them what that same coverage will cost. You may be pleasantly surprised with the answer you get. And of course, with term insurance, when it's purchased on an individual basis like this, it goes with you. So you can pay off your mortgage, you can pay off your personal loan, you can pay off whatever you've got and still keep the insurance if you wish. So term insurance is big bang for your buck normally, but there is no cash value. Permanent insurance, I always use the analogy of permanent insurance versus term insurance is like renting versus purchasing your home. Normally you can rent a home less expensively than you can purchase one, but you never build any equity in it. And at some point, if the landlord decides he's going to sell the building or the house, you may be looking for other accommodation. Whereas permanent life insurance will cost you a little more than term. You will build cash value into it. And at some point, it will hopefully be there for the long term, for the end of your life. So again, something you need to be aware of. You can check it out. Look at this. There's the disability slide I was looking for. So sources of disability income is individual disability income insurance. So if you're fortunate enough to work for an employer that has a disability program along with their group life and health program, then you're in great shape. You may want to supplement, but you may be just fine where it is. You can purchase individual disability insurance, again, from an insurance advisor, but you have to have earned income. So if you're running a corporation and you're only taking dividends, you're not going to be able to access disability coverage. Canada Pension Plan has a disability benefit as well. And as long as you paid into Canada Pension Plan, you may well be eligible for that. Their definition of disability is a little different than some individual owned disability plans, and you need to be aware of that. Company benefit plans, I talked about if you got a group coverage. Critical illness insurance, we talked about that a week or so ago. It's a benefit that pays out, and there is another slide coming up, that pays out a lump sum cash-free, tax-free benefit upon diagnosis or 30 days after diagnosis with the product I'm familiar with, which will allow you then to go do whatever you want. So we'll talk a little bit about more of that. Long-term care insurance, that's insurance you can purchase for the long term, and personal health insurance we did already talk about. So critical illness, incidence and survival rates of suffering critical illnesses are increasing. Folks are living longer and they want to maintain their lifestyles. And certainly if you deplete your RSP funds to survive from a critical illness, that's going to adversely affect how you can retire comfortably. There is a suggestion that there will be diminishing government benefits. I don't know that we've seen that yet, but there's certainly talk that some of the qualifications are going to go up for some of these things. So you may well be advised to look after things more for yourself. And the other reason, as I already touched on, is to protect your retirement funds. So a serious illness, such as a critical illness or a major long-term disability, is going to result in extra financial costs. That's just a given. You may or may not need some special equipment. You may or may not need some alternative treatment, whether it's non-drug or whether it's some specialized drugs. And I'm certainly familiar of folks that have had thousands of dollars a month in drug costs. And if you don't have a plan to cover that off, that can be an onerous burden on the household. Maybe you need some private nursing care, or you need to be able to go somewhere. And that's, again, that critical illness. If you decided you wanted to go to the Mayo Clinic to seek some sort of fancy treatment, you can use that. There's no strings tied with that. So you're going to lose income. You're likely going to require extra childcare. You're probably going to need some home assistance, and you very likely, depending on the illness, may need some adaptation to your surroundings. So it can help you to reduce debt and other financial concerns. I think I've dwelled on it enough already. You can read that slide. If you don't have it and you're interested in it, again, contact your favorite insurance advisor. They should be able to tell you all about it, or Google it up and you can look at the definitions and then just call the advisor for some pricing. One last slide on the critical illness. So different organizations have different definitions and different numbers of illnesses that are covered. This is a Sun Life slide, and as of, I believe this one was 2018, I believe. It just highlights that those 5 major illnesses made up about 90% of the Sun Life claims. So benign brain tumors, cancer, coronary artery, heart attack, and stroke. I can tell you, here's a personal story. As the name would indicate, critical illness, there needs to be damage. So you can suffer a heart attack, and I'm here to tell you I did, and I survived, and I'm in great shape, better than you. I did not suffer any heart muscle damage. So even though I have critical illness insurance, it never paid out. And that's a good thing. I'm happy about that. But you just need to be aware of the coverages that are there and how they may or may not affect you. Okay. Looks like we're doing good for time. We're just about there. So again, I just want to reiterate, if you've got some questions, because I've been going through this way too fast, put them in the chat box and Sam will look after them, get them over here to me and I'll answer them, or feel free to call me in my office whenever. So benefits paid in 2017. So this was Sun Life's information from 2018. So I was pretty good when I guessed that. 68% of it was cancers. And so you can see what the big ones are. And because we're living longer, I think it's reasonable to assume that more of us are going to develop these sorts of things. Even though we're doing better and we're staying healthier, or certainly trying to, sometimes we're genetically predisposed to get something. My heart attack, for example, it was cholesterol related, and it's a genetic thing. Who knew? Now I'm on drugs, I should be good. So when you're putting your portfolio together, which is your savings plan, you need to determine what your priorities are. You need to either seek assistance or determine how you're going to construct your portfolio, whether it's in GICs or mutual funds or stocks or a combination of them. You need to consider that you need to have insurances in place to cover in the unfortunate event that something happens. And you need to review that on a regular basis, like any plan, and make sure that it's accurate and it's still attainable, and then modify as you need it.